It is good to reconnect with most of you again. Hopefully, you can all hear me.
Yes, we hear you
So
loud
it's
and
good
clear.
to reconnect with all of you. So for those that don't know me, I think BC has done a great job with the introduction. What I'm just gonna say is that yes, I've been in Toronto for a number of years. I immigrated to this country. It feels like a long time ago in 2002 when we moved to Saskatoon. When I had to join my wife, she was doing a master's program there at the University of Saskatchewan. And I remember coming to this country in January, the coldest time, the coldest month to come to Canada from sunny Nigeria. And it was a big adjustment for me, obviously, leaving a steady, nice job that I had with good pay, coming to Canada, uh, facing the prospect of no jobs at all. And I remember getting in the winter, in the crazy winter in Saskatoon, jumping on buses, going for interviews. And I was lucky I was getting a lot of interviews because I had an English name. And so that was one thing that was in my favor, but I would show up at these interviews and the conversations would change. And it was challenging to get a job. I couldn't get a job. I ended up working in factories, just trying to make ends meet. Then left after a year or two to Toronto. What I was thinking, what am I going to do with my life? What am I going to do next? Even though I've been working in the banking industry in Nigeria for about 4 or 5 years at the time when I left. And it was so challenging to find something here. And I think my situation was different because I had an engineering degree, I had experience working in the bank, and it was difficult to find where to fit in a different country, in a different economy. And I just thought to myself, maybe the best thing to do is to go do an MBA. But the challenge was I had no money. And so we now used, my wife and I decided to take the biggest risk of our life, to take all the savings we brought here, which we've been spending slowly as we're busy looking for jobs and my wife going to school full time, to take all that savings to invest in an MBA education. And I think that was the smartest decision I ever made in this country, to invest in myself. And did that. Went to school for 2 years. Luckily, got into PricewaterhouseCoopers right after school. Very, very lucky to get that job. But again, with the expectation to get a six-figure job, I had to settle for a $45,000 job, starting salary, and and that was okay. I was excited because that was my first real job in this country. I was excited to have that job and just worked my way through, got my CPA designation, worked for about 4.5 years at PricewaterhouseCoopers in the downtown office, spent 6 months in the US, working in California. Then coming back and was so tired. Remember how exhausting it was to work for a professional firm like that. Then left and went to the banking industry. And while I was at the bank, that's when I started my firm. I started doing the CPA stuff on the side. Did it for about a year or two on the side, and partnered with my friend from Jamaica, Celia, who was at PwC. At the time, we met at PwC, and we decided to start our firm. So in 2013, that's when we started our accounting practice. Since then, we've been supporting small businesses. We've been supporting not-for-profit organizations. We've been hiring, expanding our team, and slowly growing. And so last year was in the midst of COVID. Again, I started thinking, how can I serve people more? And that's when the idea came to put all my thoughts, put some of all my strategies that I've been using, working with my clients, to put it in a book that I can share with a lot of others. And so that's when I wrote the Tax Efficient Wealth book. Um, in many ways, is a basic book, but I think that is what kept me from writing it for the first place, because I had this knowledge in my head, and I thought, for some reason, I thought everybody knew. And when I started having conversations with clients that I've been working over the years with, and just deciding, just learning from them and seeing the struggle, the challenges, realizing that a lot of them were so far away from achieving financial freedom. And that's when it came to my attention that people are really, really lost. Uh, they don't know where to start. They don't know the best way to start planning. They don't know how to do it in a tax efficient way. A lot of people don't realize that taxes is their biggest expense. And so when I started gathering all of this information, in addition to what I've been teaching, a lot of the professionals I've been working with in the past, I decided to put it together in this book to offer to everyone. So for those of you that have seen the book, hopefully you found value in it. And if you're here today, you've not seen the book, I'll probably drop a link in the chat where you can go download a free copy and read it. And it's a basic read. You'll probably spend an hour or two at most reading it, but it will open your eyes to some of the possibilities, to understand the basics of our tax system, and to start thinking about ways to shift some of the things you're doing to start building a tax efficient financial plan for yourself. So I'm happy to be here today. I think this conversation is going to be informal for the most part, and I'll be happy to answer any questions that you have today. So I'm excited to be here.
Wow, Kenny, thank you so much for that introduction. I mean, even me that I thought I know you, I don't know so many of things that you just basically said here today. But I'm really very excited for you. Why? Because, I mean, even though you and I are friends, we've been friends for a bit now, I tend to hear more good stuff about you from places that I didn't even think about. About 10 days ago, one of my former colleagues from back home in Nigeria, who works with, BDC now, used to work together in the HSBC back then, was telling me about you. And I'm like, where did you know Ken from? And he was telling me about a transaction that you guys were trying to structure around, real estate investment. Literally, you were consulting for them about how they were going to set up that stuff, how it's going to be tax efficient for them to be able to do that. I mean, I was marveled when I listened to the guy speak about you. But where I want to start from today is, I remember in our conversation in the past, you mentioned something like how to evaluate investment opportunity. You mentioned some 4 elements of what people should be thinking about. In a very quick way, can you talk about, how people should be evaluating investment of opportunity?
Yes, I can do that. Let me see if I have, I can just pull it up here and share quickly for people to see. So just give me a minute. I think I can share my screen, right? Okay, so let me see if I'm able to share my screen. Then I will share this. Okay, so share screen. All right, so there are just 4 things I look at when I evaluate my any investments, and I think I've shared this in a couple of places. I don't know. Can you guys see the screen? My screen?
It's coming up. Yes, I see it now.
Okay. All right. So for me, there are just 4 criteria that I look at when I want to invest in anything. And this is what I've been doing for many years, but I just didn't even realize it at that time, that I was applying some of this criteria when I invest. So as some of you know, you probably get a lot of opportunities to invest. I mean, I get it all the time. People are consulting me, come and invest. There's this thing that we have to do. There's this opportunity, just come and invest with us. For those of you that work with financial planners, it's the same thing. You get all these opportunities from them to invest. And so when it comes to investment, I just look at I assess that investment using these 4 criteria. The first one is tax advantages. So the first question I ask myself, will this investment offer me any tax advantages? Because I understand that taxes is a big burden, right? I understand that taxes is a big burden. So if you are in this country, you know we pay the highest, one of the highest tax rates in this world. And so I am careful when I invest, just to make sure that I'm not exposing myself um, to unnecessary tax. Right, so I pay careful attention to that. I look for vehicles that will allow me to write off, that will allow me to defer taxes, that will allow me to pay the lowest tax rates. So I look for those investments that give me that ability to do that. Secondly, I look for leverage, right? And so some of you have heard about the term leverage. Maybe it comes with a negative connotation for you. Yes, leverage can be dangerous if you don't know how to use it. But what you have to understand is this: without leverage, it is hard to accelerate your pace of wealth. It's not impossible to build financial freedom without leverage. You can do it. What leverage will allow you to do is to shrink time, right? So leverage will allow you to accomplish in 5 years what it will take you 30 years to accomplish, or 20 years to accomplish. And so I look for ways I can employ leverage in everything that I do. So whenever I'm presented with opportunity, I just start thinking right away, how can I leverage this to make the returns even better? Because leverage is sort of related to growth. If you have the opportunity to leverage, you have the opportunities to increase your returns um, significantly, right? Without, if you compare it to an investment without leverage. So I look for a way to leverage. And thirdly, I look for growth. I look for returns that will give me the ability to earn a decent return, right? Investments that will grow over time. So I'm not so interested in the short term because there's just a lot of volatility and noise in the short term. So I'm always looking at long-term growth. So I look at investments and opportunities that give me this ability to grow. And one of the things you have to understand, particularly in the times that we live, and I think the COVID that's happened over the last 2 years has even exposed this even further. So we live in a situation where inflation is ramping up, right? So if you are relying on your savings, and a lot of people do this, if you're relying on your savings, you're just going to be way, way, way behind. So if you look at all the savings rates of people that are saving money in all the different vehicles, if you're saving today and you're just saving your money for returns, the best return you can get, I mean, I think is it Equitable Bank or something that one of these banks that offer it. The best return you can get is less than 3%. That is just about the same as inflation rates, right? And that does not even consider the devaluation of the currency with all the money that is being printed, with all the debts that is being stacked up. And so based on what's happening in the economy today, I was even in a presentation this morning in another organization that I belong to here in Oakville. And from that presentation, so what I'm hearing now is if you're not making at least 12% every year on your money, you're not even going to catch up, right? You're going to be way, way, way behind, right? And so that's why growth is really, really important. Returns is really, really important. So you have to be at the minimum looking for investments that will give you at least 12% per annum to be able to even catch up, right? In this economy. So growth becomes very, very important. And the last criteria I look at is liquidity, right? I want the flexibility to be able to get access to my money. And the reason for this is you want to be able to take advantage of opportunities as they show up, right? So liquidity is always important. So if you're investing, whether it's real estate, make sure you structure it in such a way that you can pull your equity whenever you want. If you're investing in other investment products, make sure there are ways you can liquidate those products and pull the cash without maybe either triggering a taxable event or maybe figuring out a way to do it in such a way that you don't pay a significant amount of taxes when you do so. So those are all the four criteria that I use to invest.
All right. Thank you so much for that, Ken. You see, I was speaking with someone, I will not mention his name, who, I was trying to learn about real estate investment from. I consider the guy to be somebody who is vast in the environment. But I found that eventually, after a couple of conversations with him, he said to me that, I learned this from Ken. And I was like, what? Ken again? So let's talk about real estate investment. I know you have a lot of portfolios in that space, and I'm sorry if I put you on the spot. It's something that you've done continuously over the last there are about 19 or so years that you've been here. How have you been able to to acquire so many properties and build an investment corporation out of that?
Well, I mean, it started with one, right? It started with getting into the first one. And that first one was buying our primary residence in Brampton in 2006, I believe. So that's when we got into our own first investment, which was our primary residence. It always starts with one. And I would tell you the truth, even when we bought our home, the only thing I knew at that point was that it was better than paying rent. That was the only thing I knew for sure at that point when I did our first investment when we bought our primary residence. Did it cost us more to maintain? Yes, it cost us more. Did we stretch ourselves financially to get into our first home? Yes, we did. Was it painful, for the first couple of years to cope with the payments of mortgage, the mortgage, the property taxes, the utilities? A lot of the payments we are not used to as a renter. Was it challenging? Yes, it was. So that was what I knew at that point, right? I just knew that it was better to get into that space. And the reason I knew that was because prior to getting into that investment, we've attended a couple of events that just opened our eyes a little bit more to real estate. And it was an interesting time because we were trying to figure out, okay, where is the best place to buy? How can we get in? Even when we didn't have the significant down payment needed to do it. But figured out a way to do it. We took from our RSP, we took money from everywhere that we could to put together the down payment to get in. And so it started with that one. And once we got into that one, in 2006, when we got in, we just slowly started, paying month by month. We were learning. We got into other groups, real estate investments. Then it was the following year that we now bought our first rental property. And again, that property was a small property. It was a small condo, very low rise, small condo. I think it was a total of 63 units in this building that we got in. Even then, when we got in, it was not even a condo. It was just being converted to a condo. And we paid, I believe it was $135,000 we paid for a 2-bedroom unit in that condo at the time. Probably got in with a 5% down payment. And that was our worst investment that we did. We were so desperate to get into real estate that we didn't even do all the due diligence we needed to do, right? And we got into that first rental property that we bought in Kitchener. And the reason why I said it was our worst investment was because shortly after we got into it, They package the, I don't know if some of you have gotten into this kind of investment, they package it as a rental pool. In other words, a manager was appointed to manage the whole 63 units for the pool of all the investors that invested. In other words, they will make everyone even. So if there is vacancy in one or two units, they can take money from the other units, investors, and take care of the payments to make everything even. But less than a year into that business, the property manager, they just ran that project down. The vacancy rate shot up and they couldn't manage, they couldn't keep up with the cash flow. And so they handed everything over to all the investors. Some people couldn't cope. They raised their hands up. The banks came in, took over a couple of units. We kept our own units. We probably carried it for about a year or so with no tenants. We didn't even realize there was a second mortgage on our property until the person called and said, "Where is my $20,000?" I said, "What? $20,000?" So my wife and I had to look for where to borrow the 20,000 to pay off the second mortgage. We still head on to that property. And so what we learned from that experience, because we head on to that property, we head on to it, we eventually sold it. When we bought it in 2007, we sold it about 2015 or 16. So probably we head on to that property for about 10 years. So what we realized that, holding on to that property. So when this issue happened, I got onto the board. I started learning a lot of things as well. I got onto the condo board. As part of that board, I started learning a lot of stuff, getting exposed to a couple of other investors. Through the property manager, we hired a new property manager. Through that relationship, they found another investor that came and bought about 28 units that were ahead with the banks. And by doing that, we were able to recover a lot of the unpaid condo fees. And now the condo had some money to start investing in the project, to start maintaining the lawns, to start maintaining some of the common elements. And then slowly people started coming back into the building, to the units. And then we started seeing the appreciation go up, right? And eventually, I think we sold. When we sold it, we probably broke even, or we made a little bit of money. But it was a good experience to learn, to understand some of the things that are driving real estate, and then figuring out how to manage your property, and trying to make sure that you're in control of your own investments. And so that's why these days when I invest, one of the things I look at is being able to control what I invest in, because I don't want people to start making decisions that will drive my investments down, right? And so those are, and it was just from there. So from that experience, and we started seeing appreciation go up, and then we just started taking equity from the existing properties to buy a new one. We started getting into a relationship with other investors that will invest with us, and then slowly we're just buying property year after year, year after year. And from time we'll sell one or two. But for the most part, we just buy and hold. And so that is what we've been doing over the years. And it has never been easier, right, to buy the next property. So this is one of the things I always say. It's never been easier to buy the next property. It has always been ways, we've always had to stretch, okay? How do we get the down payment money? How do we ensure that we carry this property so that it cash flows? How do we get the next investor that will help us expand or grow this portfolio? So it's never been without challenges. It's never been easier. But one thing I can say is that because we've been doing it for so long, and all of you have seen the way real estate prices have been going up, we've benefited greatly from it, from the growth in real estate. And people ask me all the time, why are you bullish on real estate? Right? Why are you bullish on real estate? And I always say, well, if you look at the way things are trending, right? Whether it is the prices of building materials, whether it is population that is coming into this country, coming into Ontario, um, whatever it is. So there are just a lot of fundamental factors that we've been looking at over the years. We've been learning, studying by being part of different groups. There is just the fundamentals that we've been looking at. And once you
Welcome.
focus on those fundamentals, you begin to see that, for the long term, uh, real estate will just continue to go up, right? So I've not been focused on media. I've not been focused on economists. A lot of them have been wrong. And the reason why they've been wrong is because they've not kept their eyes on some of the fundamentals that are driving the real estate prices. And what I just said to people, if you think 2021 is crazy, just wait until we get to 2026. And you will see what I'm talking about. Because 2021, I'll tell you the real story. What we're experiencing in 2021, my wife and I, we experienced it in 2015 when we moved from Brampton to Oakville. It was exactly the same picture, right? When we are looking for a house to buy in Oakville, it was the same thing. Multiple offers. We lost out on several opportunities until we eventually found a house that we bought and then moved in. And so it's the same thing. When people were asking me, it was the same thing. Are you crazy buying a house in 2015? And then I didn't even have the foresight. If I had the foresight, then I would have told them, why don't you wait until we hit 2021? And today, when people ask me, I say, because I can see the data, I see the drivers. If you ask me, I just say, wait until 2026.
Wow, Ken, wait until 2026. I like that.
Yeah.
Okay. I want to touch base on something. I think the first thing that brought us together is I'm in the insurance space. You are more of a tax person and real estate investment person. The first person that recommended me to talk to you, recommended you that I should speak with you, said, you need to read an article that, Ken wrote. And after I finished reading that article, I knew I had to speak with you. And that was, in the article where you spoke about how, you know, insurance can be used as a tax planning strategy. After I spoke with you, you went on to describe, the way you look at your investment strategy of, tax advantage, growth, leverage, and liquidity. And then you just basically use that to explain why you would invest in an insurance, product. Do you want to take a moment to just basically explain what was your thought process and then, your knowledge of taxes? How does that work?
Yes. So yeah, I can talk about that surely. So in this country, there are how many things are there that are tax free? Not a whole lot. You're right. So your primary residence is one. So as some of you know, if you buy your primary residence in this country, is one of the things you can sell and pay no taxes, right? So that's one of them. Your primary residence is tax free. Today we have the TFSA. TFSA is tax free. So if you invest in your TFSA, that money grows tax free, right? So your TFSA can grow tax free. You can pull it out, enjoy the growth, and you don't have to pay taxes on it. The the third one is insurance, right? So there's something called the tax exempt life insurance. Tax exempt life insurance, if you invest in life insurance, if anything happens to you, you die, your beneficiaries get it tax free, right? I don't know, I feel like I'm missing one. Lottery. Lottery is the other one. That's the final one. So if you win lottery in this country, you don't pay taxes. Your proceeds are tax free, right? So there are only four things in this country that you can get away with without paying taxes, right? So just four things. Unfortunately, if you die, yeah, you pay taxes on death. So some people wonder why, well, how will a dead person pay taxes? Well, if you die, you leave an estate, and whoever is managing your estate will pay the taxes on your behalf. So even death is not tax free. But in this country, we have those four things that are tax free. And if you're here, you're not taking advantage of all of those things. I mean, I don't play lottery, but lottery is gambling. If you think you're lucky, you have the ways to win lottery, then well, man, go for it and play lottery. But all the other ones, I mean, if you're here and you're not taking advantage of any of those things, then yes, you should be. You should be. I think you'll be missing and losing out a lot if you're not. Now, I'm gonna confess because the insurance one is something that um, I didn't catch on for a very long time, even though people were harassing me for such a long time. How come you're not buying permanent life insurance? So, and the reason is this, and I think that it was my decision at that time too, and I think a lot of people think the same way. So we look at insurance all the time as an expense, right? So that's one of the biggest mistakes we all make, right? And obviously that was a mistake that I made several years ago. And when I was looking at insurance, I just looked at it as an expense that I couldn't afford to make. I mean, I was lucky I was able to buy some insurance, which I had in place for so many years, um, and so that worked for me. But what we need to do is to start looking at insurance from a different lens, right? Look at it from an investment lens. And the reason you do that is to have exactly what I said in mind, that tax exempt life insurance, the proceeds are tax free. And it becomes an investment vehicle that you can use to accelerate your wealth. And when I look at insurance, it just meets everything in the criteria that I talked about earlier when I want to invest. It has the tax advantages. And the reason is because if you invest in the right investment, the tax exempt permanent life insurance policy, that policy grows tax free. It has leverage or ability for you to leverage. And people will ask, how do you leverage investments? Well, if you do it right and you buy a nice, good dividend participating whole life insurance policy, and then you know that you have cash value that grows with that policy. And you know you can turn around and take that cash out and then use that cash to invest in something else without interrupting the growth in insurance policy. So by doing that, all of a sudden, you've created this investment structure where you have the same amount of money that is being invested in two different places, right? And so you have it growing steadily in the insurance policy at a fixed rate that is compounding nonstop year after year. And then you can pull it out and invest in a different product, maybe real estate, maybe in a nice dividend paying stock, maybe in a business, right? And allow it to um, grow again efficiently. So that is what I didn't see so many years ago, right? And so, I mean, it's something I implemented recently, and I'm just looking for ways. I'm even looking for ways to really accelerate that right now. But so if you're here today and you've been always looking at insurance as an expense, I think you need to step back and start looking at it as an investment opportunity, right? Because if you start looking at it that way as an investment opportunity, then you will not begin to see how you can leverage it, how you can allow it to grow your wealth tax efficiently, and how you can use it to provide, ultimately what we want to do is to provide a good foundation for our kids, if something happens to us at some point. So that's something I think a lot of people should start thinking about in terms of the way they look at life insurance.
Thank you, Ken. I remember you and I worked on a scenario together when we were talking about life insurance. Guys, let me tell you what Ken was saying to me. That if you buy a certain type of life insurance policy, like he mentioned, a permanent life insurance, which could be either whole life insurance or even a universal life insurance, you have investment that is growing inside it in a tax-free, regime. You can take money out of that without necessarily breaking the investment. You collateralize that particular investment, use it to set up another business or use it to invest in another thing. What I found, which was profound for me in the conversation we had, Ken, was that the interest portion on that particular leverage amount, you can write it off against the business because it's a loan business expense that you won't have to, pay taxes on. I didn't used to think about it that way. Even though I set up investment in two places, tax advantage level of the second investment is even greater than the first one because I'm writing off so many expenses from borrowing money against that first one. I want to say
Sure.
thank you so much for, for that experience. Now I'm beginning to see some of my clients saying they want to use it to be able to create their own bank by themselves. So people will take money from their life insurance, collateralize it, and go and use it to buy whatever they want to buy, and then begin to get more returns on their investment. I want to talk quickly about something that you've also taught me. When you keep saying leverage will help you to quickly grow your investment in the process of wealth building, let's talk about, leverage helping you to accelerate wealth building, and then talk about debt, process of how you do that.
Well, so leverage is just the understanding that if you want to keep saving and deploying your capital, then you can certainly do that. You can certainly do that to build wealth. A lot of people do it, but it's just going to take you time, right? And if you don't even have the right income to be able to do that, then you may never even get there, right, in the first place. So that's why leverage becomes so important. And what is leverage? Leverage is the ability to use other people's money, to use other people's time, to use other people's resources, to help grow whether your business, whether your investments, whatever it is, your assets, right? And that's one reason why I love real estate. The fact that all I have to put down is whether it's 5%, 10%, 20% to be able to acquire an asset that I can control, right? And so that gives you a lot of leverage. And that is why I look at investments that way. I look at opportunities to grow wealth that way. And it's the same thing with business, right? And so if you want to start a business, I'm always looking, how can I make this business run well with leverage, whether it's people I'm hiring, whether it's the technology I'm employing, whether it's the loan I'm getting from a bank to help fund or start the business. So I'm looking for ways to tap into different sources of leverage to allow me to do more, to allow me to get into business. Because once you have leverage, your return on that investment increases significantly, right? So if I have to buy a house of $100,000 today, I know it's hard to find. You probably won't find that in Canada. Let's say you can even buy a house for $100,000 and I have $100,000 to put down to buy that house. If I do that, and let's say at the end of the year, all I can make from that house is $10,000 return, right? If I do that, then all I'm getting is a 10% return on my money, right? But if the bank allows me to put only $20,000 of my money to buy the same house for $100,000, then all of a sudden, instead of me buying one house for $100,000, I can buy 5 houses for $100,000. So you see the magic of leverage. So the 5 houses that I buy will now increase my cash flow. Instead of making $10,000 on one house, I'm now making $50,000. And all of a sudden, my return has gone from 10% to 50%. So you see the difference that leverage makes. So that's why it is critical. It is critical to always think of ways to employ leverage in everything that you do. And so I do it all the time. Whether I'm investing in insurance, is the same thing. As soon as I put money in insurance, I'm always thinking about how do I pull it out and then use it to do something else so that it keeps growing. It keeps moving. And there's this concept I talk about in my book, the velocity of money, right? And so you got to keep that money in motion all the time. As you're investing, as the equity is growing, start thinking about, okay, how do I deploy that extra cash? How do I deploy that extra equity? How do I stack leverage upon leverage? But obviously, you have to be careful to make sure that you're watching your debts as a whole, as a percentage of your asset value, just in case things move, right? And so you don't want to be over leveraged. You have to be very, very careful when you're doing it. But again, once you combine leverage with the velocity of money, ensuring that all the time you're putting that money in motion, you're always investing it rather than spending it, then you begin to see the beauty of investing carefully and doing it in such a way that it will allow you to use leverage and use it wisely to your advantage. So I mean, I encourage you to start thinking about ways to deploy whatever resources you have. Always think about, what's the leverage in this, right? And if you have $10,000, I always think, okay, how can I leverage this with someone? Maybe partner with 2 other people, with 10 other people, and just get into some investments and start leveraging other people as you move along.
All right, thank you so much, Ken. Something you said in that resonated with me as to something that I read somewhere before. Using other people's money is just basically what you've been talking about here. There's something that I read somewhere which I like to quickly allude to. A lot of us, as people, either use money in 3 ways. One is some of us are using debt, leverage. We don't have money. We just basically borrow money and buy whatever we want to buy, whether it's an asset or whether it's a liability, whichever one we're buying. But we keep paying down that money that we borrow until we finish paying it. And then we continue the cycle like that, borrow again, go and buy. Some people will save money because they want to buy stuff. The moment they get to the amount they want to use to buy whatever they want to buy, they liquidate that investment and then go and use it to buy whatever they want to buy. They go back to ground zero and then start to save again so that they can buy whatever they want to buy the next time. Whether you are using leverage and paying it down, or you are using your own money that you have saved and pay it down, both of those scenarios, you come back to ground zero. Everybody comes to zero. But you see, the idea behind what you've taught me and what I've also read so much about is leveraging your asset. Put your investment in a place where it is growing, collateralize that investment and go and use it to, do another investment. And in that way, you are just basically accelerating your money. Now, I want to quickly talk about something that you and I spoke about in the past. You mentioned to me that the only way people can basically get by is to have a business instead of just basically being an employee of an organization. Do you want to talk more about that and then, share your thoughts on how that works?
Yes, so I love business, and the reason I love business is because it's one of the tools that employees who are the most taxed in this country is one of the ways employees can begin to get some of the benefits of taxes, some of the benefits of how to efficiently begin to manage their tax liability. And the reason is because business gives you the leverage to begin to think of ways to convert a lot of the expenses that you're spending today, right? A lot of the things you pay money on today, how to begin to convert that from your after-tax dollars to your before-tax dollars. Because as employees, what do? We go to work, we earn these big salaries, we come back, and then at the end of the day, we pay these taxes to the government. A lot of us, as because I mean, I was a full-time employee as well. We don't even get to see this money. They even take it out from your pay slip before it gets to your hand, right? And so that's what the government does. So they take the money from you, then they give you a portion of it, and then what you have, you now go spend it. So we earn money, we pay taxes, then what is left is now what we use and we fund our lives. So we pay, we buy gas for our vehicle, we buy food, we send our schools, we pay for school children activities, we buy all the stuff we need for our homes. So that's what it is, right? So we earn income, government takes their taxes, then whatever is left is now what we spend. But think about the business person, right? So the business person makes money, they write off all their expenses. Whatever is left, they pay taxes on it, right? And then they whatever is left and is theirs they keep. Then the other thing to consider is again, as an employee, you're paying taxes up here. As a business owner, you're paying taxes here, right? So the regular employee, the average tax rate, let me now say the average because sometimes it gets people confused. So the top marginal tax rate in Canada is 54% or thereabout if you live in Ontario today, right? So let's say you're making over 200,000 a year. On your top dollar, you're paying about 54% in taxes. But if you own a business, your tax rate today is going to be 12%, right, within your business. If you have a corporation, right, then if you own a business, you pay 12%. So if you look at the difference between that, right, you can imagine how crazy it is. That's why people that are employed are paying are paying a lot of taxes. They bear most of the burden. Obviously, because we have a marginal tax rate system, a lot of people end up somewhere in the middle because you pay the rates are lower. So the lower your income, the lower your tax rate. As your income goes up, your tax rate goes higher as well. And I explain a lot of that in my book. So if you own a business, even though you own a sole or you run a sole proprietorship business, at least you can begin to write off some of these expenses. You start looking for ways to design your life around your business so that everything you do may even have a business reason associated to it. So now you begin to convert a lot of the things you will ordinarily spend money on with your after-tax dollars. You begin to look for ways to convert them to before taxes dollars so that when you make money, you can now write off some of these expenses so that you can reduce your taxable income to a certain reduce it a little bit so that now you don't have to pay a higher tax rate on that income, right? And so if you do that, you may end up saving $1,000. You may end up saving more depending on the kind of business you run. And if you save a little bit, whether it's $10,000, and then you can take that $10,000, invest in a leverage vehicle and make additional returns, and then take that, allow it to compound, you begin to see how small differences can begin to make a lot of big impacts when compounded over a few years. So this is why I love business, and this is why I think a lot of people can employ business even in their personal lives as employees. So I always look at it this way: if you are an employee in this country, you need to have your own home. If you don't have a home, that should be your first primary target, to buy your own primary residence. And once you get your primary residence, your next goal is to get a second home, your rental property, and to get a business. And I think once you have these three things, you have your job, you have your primary residence, you have a rental property, you have a business, then I think you've come into that zone where you begin to manage your taxes, to begin to grow your wealth in a very significant ways. And so that's why I think everybody can start there. And I think it's really not that hard to get there, particularly if you have a job. And if you don't have a job, then the other thing to start thinking about, okay, how can I start creating income for myself? And if you have a job and the income is not that high, then start thinking, okay, what can I do to start growing my income? What can I do to get promotion? What can I do to get a better job that pays high income? What can I do to add a business that can generate more income? So that will allow me to buy my own home if you don't have your own home, that will allow me to buy a second property, and then that will allow me to start a side business.
All right. Thank you so much, Ken. I know our time is, fast spent. Um, I just basically will ask you one last thing, and then we can have question and answer. I have a lot of people who have said that they want to, ask questions. They've sent message to me privately, but I want to quickly first say thank you for those who are asking for for Ken's book. This is one of the things that I like most about this guy. When I bought the book, he said to me, why did you have to buy the book? That I could have given you a copy of the book free. And I remember I said to him, I once wrote a book, so I understand what it takes, for an author to write a book. We have to support it. But he kept saying, I just want people to read this thing. So if you are looking for a book, for his book, he put a link on there. You can download a free copy of the book, for your own reading. So what are the tips that you want to be able to give people so that they can begin to elevate their financial awareness?
Also, I think the most important one is just to understand where you are today. So a lot of people, I think there's a framework I use to teach people this on where to start. So start by understanding where you are today, right? Understand where you stand today. One of the questions I love to ask people is, pull your tax returns, go back 10 years ago, right? See how much money you've made over the last 10 years. And a lot of you will be surprised when you do this exercise. I was when I did it for the first time. Just go back, pull all your tax returns for the last 10 years. If you go to your My CRA account on Canada, they have your last 10 years if you don't keep copies. Add up all the income you made over the last 10 years. Then ask yourself, of all this money I've made over the last 10 years, how much of it have I actually kept? Right? And I think this is an exercise that everyone can do. Look at the last 10 years. Okay, how much? Let's say you've been making $100,000 a year for the last 10 years. So I've made $1 million for the last 10 years in income that has come poured into my life. Now ask yourself, of all that income that I've made, do I have at least $1 million in net worth? Right? You've made $1 million. So maybe you should have at least $1 million in net worth. Right? So it's the same question I ask you. If you've made 50,000 for the last 10 years, that is $500,000. So look at your life today and say, okay, can I show that I have at least $500,000 in net worth today? Right? And so a lot of you may be surprised, you may be disappointed, you may be excited because you've exceeded way more than that. But it's always a good place to start. And then if you're disappointed, one of the things I'll say, okay, now you know, start thinking about some of the mistakes you've made. But now you know where you stand. It's okay, oh wow, maybe I've made a lot of mistakes with my investments. Maybe I've just been blowing this money, spending it on travel, buying fancy cars, buying bigger houses that I can afford, that I can hardly afford to keep up with payments. Spending on all this, and then start thinking about that, right? And so now you know where you stand. And then from today, just press a reset. And so, okay, what would the next 10 years look like? So what do you want the next 10 years to look like? Where do you want to be 10 years from now? And so if it's to build $1 million net worth 10 years from now, then yes, start planning towards that, right? And then set that goal and then start assessing. Okay, so if I want to build $10 million or a net worth of $1 million from today, 10 years from today, now you start looking at yourself. Okay, how much money is coming in? How much am I spending? How can I shrink my expenses? How can I grow my income? Then now, how can I take that difference and start investing? Now, using some of these things I've learned today, looking for things that will give me tax efficiency, looking for things that will allow me to leverage, looking for products that will give me good growth, things that will allow me to get access to my money so that I can always keep my money in motion, right? And then look for those things and start implementing. So I'm going to encourage you, if you're here today, to start thinking through all of these things. And then from today, just press a reset and say, okay, how do I move from here to make 10 years from now look much, much better? And always look for ways to seek help, right? A lot of us, we didn't get here today because we did it on our own. We found a lot of people to help us, right? I've paid for coaches, several coaches in the past. I spend lots and lots of money every year on personal development. And some of you, if I tell you how much, you think I'm crazy. Um, but it's just needed. Sometimes you think maybe I don't need all this education, maybe I don't need all this knowledge, maybe I don't need coach. But you have to realize that if you're not working with people that will help you accelerate, you're just going to slow your pace of growing. You're going to make mistakes that are costly. You're just going to waste time trying to learn. But if you can find ways to shortcut your freedom, to shortcut your learning, I would do it. Look for people that will coach you. Look for people that will support you. So I think that's, I believe I've packed in a lot of tips here, but that's all I think I can share right now. But I have a framework that I use to teach all of these things for people I work with.
I mean, Ken, I can't thank you enough for what you've done here. When you and I sat down last year, and then you sent me that framework to say, BC, if you and I are going to be able to work together as friends and as mentor mentee, this is the first thing that I need you to look at. By the time I finished with that, I can't forget that Excel sheet you first sent to me. I knew already that I was lost, even though I was making a lot of money, right? But I want to thank you because between that time and today, I know where I am and I see, with what we're doing together and all of that, where we're going to, be over the next 10 years. So I thank you so much for the opportunity to work with you and then, to share knowledge with you. A lot of people have said they wanted to ask
You're welcome.
questions. I know the first person that said he wants to ask question was Robert. So if you could please unmute yourself. I will take it in this order because you guys send personal messages to me. Robert is the first person, then Obina is the second person, and then I think I have a couple of questions that people have sent to me directly.
Hello there, Ken. Can you hear me?
Yes, I can hear you. Good to see you. Long time.
Yes, yes.
Wonderful.
First of all, Ken, thank you for taking the time to do this. This is something that's very, very important in our community, financial literacy. And so I really appreciate you doing this and also appreciated your personal story of perseverance. When you
Thank
first
you.
arrived in Canada, you weren't discouraged. That's very encouraging to me. So my question is this, Ken. It's probably an obvious question. I mean, the real estate market in the GTA right now is exploding. It's at a tremendous high level. So there's two scenarios. One is those who are outside the market are going to have a difficult time getting in right now with the GTA. But talk a little bit about those who are in the market, who have realized significant increase in value of their properties. What are your suggestions? What would you recommend in terms of utilizing that increase, that equity that you're sitting on, because you're sitting on lots of equity for if you own a home in the GTA right now. I know some people I've talked to are selling and moving to cheaper communities. That's
Yeah.
I'm sure that's an option.
Yeah.
So can you talk a little bit about what kind of advice you're giving to those who are in the market who realize increases?
I mean, certainly at the end of the day, it depends on your goals. So if you want to continue to grow, to invest, I will look for ways to tap into that equity, and whether that means selling and moving. For you, if you want to move to a different community, if you want to move to a cheaper community where you can buy a house for cash and then maybe take the difference and invest, then maybe do that. That's what you do. So right now, I will tell you what we're doing. Even my wife and I. So we have two of our properties listed for sale, but we have them listed for a price that we want to sell them. And so what we've decided to do, if we don't get the price, we won't sell. We're just gonna take the equity and do other projects that we want to do, invest in something else. So the most important thing is to tap into that equity that you have. So right now, if you have a home that you're sitting on, interest rates are low now, go to a bank and see how you can set up a HELOC for your property. Even though you don't know what to do with it, the money, just set it up. Set it up so that way you have access to that cash and then you can start looking. I know prices are crazy in this market, right? I know prices are crazy in this market. Depending on how much you have, if the prices are crazy in the GTA, just look for areas that are 30 minutes, 1 hour outside of the GTA and go there, because what's happening is that people are moving in that direction, right? If you see all the population that is coming into Ontario, you see a lot of people that are leaving Toronto and they are moving to Kitchener. People are leaving Kitchener and they are moving to communities that are surrounding Kitchener. So there's all this movement that is happening and people are just expanding. And so I will continue to go to those communities that people are moving into. Look at where GoTrain is going. Look at their 10-year plan, their 5-year plan, and then start investing in those communities where development is going to get to. One thing I'm going to encourage you to do is always to keep your eyes on some of the fundamentals that are driving real estate, because people just keep asking or making comments. This market is not sustainable. These prices are crazy. But if you look at a city like Toronto and compare it to major cities across the world, you realize that Toronto is really, really cheap, right? And so there is room for this city to continue to expand, for prices to continue to go up. Are the prices crazy? Yes, they are. Some of the things that are happening in markets are absolutely insane. Would prices come down? Yes, they may come down, right? And they've always been coming down, right? So even over the last 10 years, right, there are instances where you see declines in prices. But those things will just happen for a moment, right? But over the long term, you see that the trend will always continue to go up. And the only thing that will stop that trend from going up is when there is an increase in supply that will match the increase in the number of people that are coming into this country, right? And as we know, as the data shows, that supply is not catching up, right? The supply in terms of inventory in housing is not catching up. Is not catching up to the number of people that are coming into this country, and particularly those that are coming into Ontario. And so if that fundamental continues to hold, then I don't see why prices will not continue to go up. So if you own an asset, and if you're thinking, well, if I don't sell now, I will never get that opportunity again, then I'll just tell you, no, just wait 5 years from now, you see what will happen. It was the same thing when I was buying here in 2015. So people that were selling, they thought they were getting the best prices. When they left, and easily the house I bought in 2015 is double today, just 6 years later. So those are some of the things you just have to be watching and paying attention to. So if you're sitting on real estate, I would just look for ways to double down and buy more if I can. If your plan is to continue to grow. I know a lot of people that are retiring. What they're doing, they will sell and then go to a smaller community, buy a $300,000 house for cash, invest the difference in 1 or 2 rental properties around their surrounding areas, and then they can retire.
Okay, thank you, Ken. Great answer. Thanks.
Thank you, Robert. Thank you, Ken. Obina, I know you wanted to ask a question. Then after Obina, I have somebody more that sent a question to me, and then we have 2 other people raising their hands. We would like to stop this at least by 7:30, but if there are more questions, I don't know, Ken, I know you have a place to be, but we try as much as possible to reduce this.
Yeah.
Obina.
Hi, Ken. Can you hear me?
Yes, I can hear you.
Thank you for being here with us. It's been a wonderful session. My question is on the other side of Robert's question. Robert was asking for people that already on equity in the real estate market. What of those of us that are not in the market? Right now, it seems like the barrier to entry is kind of high. Like a lot of us have kind of had down payment for a while, but unable to qualify for meaningful mortgage to get into the market. So what would be your advice to people in that kind of scenario?
Well, I will just figure out, I will do anything I can to get in. Right, so maybe you're looking, so if I understand it correctly, you're looking to buy your first primary residence. Is that correct? Right. Oh, okay. And where are you looking to buy?
Well, Hamilton. I'm in Hamilton, so.
Okay. Could you move 1 hour outside of Hamilton to buy?
I could, yeah.
Okay. Will you get something cheaper?
I guess.
Yeah, then I would do it. When we bought our first home in 2006, we wanted to buy in Toronto, but we didn't have the income to do it. So we moved to Brampton because Brampton was the cheapest place we could afford. We bought in Brampton and we were taking the GO train to downtown Toronto to work. And we did that for 9 years before we moved. So I would move somewhere. For you, what's important now is to get into the game today. Because if you're there waiting for the market to cool down, then you'll never get in because it's not going to cool down. So I will move, look for where to move, 30 minutes away from where you want. If that doesn't work, move another 30 minutes away. Keep moving until you find somewhere you can afford. And if that doesn't work, look for maybe a friend or a family member. I think if 2 of you come together, then maybe you can afford to buy something in Hamilton if that's where you want to be. And then figure out a way to live together for the next couple of years. And then both of you can now move and buy your own thing at some point.
Okay, sounds good. Thanks, Ken. Thank you.
Hey, you're welcome.
All right, Ken, before I ask another person, someone sent me 2 questions. I'll just quickly ask you. He said, the first question is sole proprietorship considered as a corporation?
No. So if you're a sole proprietorship, you don't have a corporation. What that means is that you run the business in your name or in a registered business that is tied to your name. In other words, once you are a sole proprietorship, you file just one tax return. So you still file your personal tax return, but in your personal tax return, you're going to have a schedule for your business. And in that schedule, you can declare your income, your expenses. If you have a loss, that loss will offset your employment income or income from other sources. If you have income or profits, that profit will be added to your personal income, which may increase your taxable brackets. So it's different from corporation. Corporation is a separate entity. So it is corporations that get to pay taxes at 12%, right? So those are the differences.
Wow, Ken, you just said something that I didn't even know before. So if I make profit as a sole proprietorship, that profit will be added to my normal employment income, and that can then determine what my marginal bracket is going to be.
That's right. That will increase.
Wow.
Ultimately,
Okay,
likely
I now
increase
know what happened to me
marginal
before
bracket.
now. You know, you mentioned to me that I should go and register a business, and I told you that I already have a business as a sole proprietorship. I didn't understand what you just said now. Thank you so much for that.
Yeah, you're welcome.
The second question the person asks is, what is your advice for newcomers into Canada? Where can we start from?
Well, it's similar to the advice I just gave earlier on. Again, it's just looking for where you can afford to buy, and hopefully with the work situation, a lot of you are able to work from home. So maybe moving so much outside of the city may not be so much of a big concern. So that's what I would do. You know, look for wares that where places affordability now is a big issue. So look for areas where you can move to be able to afford. The most important thing is just to get into the game, right? So that's the most important thing, because if you don't get in now, then it's going to be harder to get in next year. It's going to be harder to get in 5 years from now. It's certainly going to be harder to get in 10 years from now. So you want to get in now so that at least you're in the game and you start benefiting from the appreciation that will happen several years down the road. So I will look for ways to get in and just look for ways to persevere through the situation, right? If you have to borrow money from different sources to make your down payment, do it. If you have to go to private lending to get your first mortgage, do it. Just make sure it's something you can afford when you do all the calculation. But don't be scared. Don't be scared to stretch yourself. That's what I'm going to say. Don't be scared to stretch yourself. You'll be amazed how you can get through it. And it's always scary. It was scared when we bought our home in 2006. We had the same questions. How can we afford the mortgage? How can we afford all the payments? And I really didn't know how challenging it was until I got into it, right? Because at the time we were paying rent of $1,000, right? When we moved, but all of a sudden that $1,000 in our housing cost became close to almost $3,000, right? When we added the mortgage, the property taxes, the utilities. And so sometimes it just, it's gonna take a stretch. But what you realize is that all that money it becomes a way to force you to save, essentially. So I'm just gonna encourage you to look for ways to get into the game.
Thank you, Ken. Mr. Mike Igbokwe, you are the next person.
Thank you so much for the opportunity. Ken, thanks a lot.
Hello, sir. Good to see you.
This is my second time of attending your lecture. I appreciate the fact that you're always ready to give out information.
Oh, thank you.
So people will have more knowledge and understanding of the market and avoid mistakes and make progress. God bless you for that.
Yeah, thank you.
I have read your book and I find it very useful and interesting. It's helped me, someone who's new in Canada, to understand a couple of things and how to navigate a couple of things. So thank you so much for that.
Yeah, welcome.
My question borders on a statement you made. You did say that if one is selling his primary home, he's not going to be paying tax. So my question is, if one sells his primary home and doesn't pay tax, definitely he has no more primary home. Whatever, if he decides to buy another primary home and decides to sell it after a while, would he be precluded from paying tax on that same primary home because he didn't pay tax when he sold the first primary home? Or is it a one-off thing?
So thank you for asking that. I think that's a very important question. No, it's not a one-off thing. So you can do it several times, but you have to be careful when you do it. So this is one area that a lot of people abused several years ago, and CRA started cracking down on people. So long as you have your primary residence,
Yeah.
anytime you sell your primary residence, you don't have to pay taxes on your primary residence. And my agent, when I started investing in real estate, when I joined Rockstar Real Estate, I had a coach that they assigned to me. And just in conversation with that coach, I realized that he had moved 23 times.
Whoa.
All in, and imagine this, all in Oakville.
Whoa.
And so for those of you that know what has happened in Oakville over the years, you can imagine how much money this guy has made. And the only reason why he did that, why he moved 23 times, is to take advantage of the same thing we are talking about,
I
because you
see.
can sell your house without paying taxes. So CRA realized that a lot of people were abusing it. So people will move into a house. A lot of contractors were doing it. Some real estate agents were doing it. People that were smart in those days. So they will move into a place. They will fix the house up. They will stay in it for 6 months, 1 year. The property will appreciate in price. They will sell it, take all the capital gains. They don't have to pay taxes. They will buy another one. So that was what this my friend did for several years. He's not told me the story of his experience with CRA, but I'm sure he has some story around that. And so there are some people. So CRA had to close that loophole.
Okay.
So now you can't be doing it every time. So you can't move in and start moving every year, right? So that will come across easily as you are intentionally doing it for profits,
Okay.
right? And so if you have a house and you're moving every 2 years, every 3 years, every 4 years, every 5 years, then obviously you can sell and you don't have to pay taxes because it's your primary residence. Now, if you decide to move and you don't want to sell your house, right?
Yeah.
When you move, which is what I did when I left my house in Brampton, I didn't sell my house immediately. I moved and I converted my house to a rental.
Okay.
So if you decide to move to buy a new house, so what you have to do on the day you move, that house becomes, there is what we call a change in use. That house now becomes a rental property the day you moved out of it.
Okay.
And so what will happen, you have to determine the value of that house on the day you move. So now with taxes, we always have to report our primary residence, even in our tax return. Even though we don't have to pay taxes, we have to disclose that.
Okay.
So the day you move from your house, you have to determine the fair market value of that house on the day you move.
Yeah.
So that now becomes your cost for rental purposes. So on the day you move, the fair market value of your house becomes your process of disposition, deemed disposition in this case, that you've sold your house. But now because you've sold your house, you don't have to pay the capital gains, right? But now that becomes your cost base. So let's say when I moved from my house in Brampton, the value of the house was 500K. I don't have to pay tax. So that 500K is my cost of my rental property that day when I moved. And so a year later, I eventually sold my house in Brampton. And let's say I sold it for 600K. So my gain, my capital gain on that sale is 600 minus 500,000, which was the value on the day I moved. So now I'm only paying capital gains taxes of, so I have a capital gains of 100K. With capital gains, we only pay tax on half of it. So I have capital gains of $50,000 that I have to pay. Yeah. Right? So that is what we do. So I always encourage people. So if you read my book, you will see that I encourage you on a strategy where you move 3 times, 4 times, if you can afford to do that, right? And the whole reason you do this is because you want to lock in those gains as you move from one house to other. And you can choose whether you want to sell or you want to keep it as a rental property and move into the next one. But that's the strategy. And for me, I've only moved 2 times in this country, but I think I have 1 more move to make. But again, I encourage you guys, try to move at least 2, 3, 4 times in your career before you eventually settle into to your home where you want to retire.
Thank you so much, Ken. We have 2 more questions, and please, because of time, we won't be able to take any more after that. But please, Ken, I would like you to address these 2 questions. Someone asked me, quick questions, please. I would like to know Ken's take on investing in pre-construction with a plan to reassign before closing? What's your take on that?
Well, pre-construction is great. I mean, it's something I've done over the years. So pre-construction has its risk, but it also has lots of advantages. The fact that you can put in money down now to lock in a value for a property that may not be ready 3, 4, or maybe 5, 6 years down the road is always a great investment. So the pre-construction investment that I've done over the years, they've paid me well. I've done really well with them. And so I like the idea of pre-construction. So now when you assign and sell, you have to realize that there's a capital gains, right? You have to pay taxes. So that's one of the reasons why I don't like selling properties, because anytime you sell, you trigger taxes. And so I try to be very intentional when I want to sell to make sure that I have something to offset the taxes. So if you are planning to buy and sell them before you close, you have to realize that, well, you pay taxes. That's one. But secondly, you may be losing out on potential increases, right, in value if you had waited to close on the property and maybe rent it for a few years before you eventually sell it. But that's a good strategy, and I know a lot of people that have done that strategy where they buy lots and lots of pre-construction, and then they reassign them or sell them at some point and build up capital. I mean, you can certainly do that. I know these days with the new rules, they made it a little bit harder to buy, because for now to get into pre-construction, you have to go through the whole qualification again. To make sure that you qualify, but certainly that's a strategy. If that's a strategy you want to use to at least build some cash, then certainly that is a strategy you can employ.
Thank you so much. And then the last question, somebody asked, Ken, please, are you saying it is better to have a corporation business rather than sole proprietorship in Canada? I think the answer is yes, I can.
Well, I mean, that's not what I'm saying. Corporation, you got to realize that having a corporation comes with cost, right? Because you're going to cost money to set up the corporation. It will cost money to maintain. It's going to cost you money to file the tax return for the corporation every year. So what I always recommend is this. If you have a business, I would suggest you start as a sole proprietorship, particularly if you're not sure which direction you want to take that business in. Because a lot of people start business and after a year or two, they shut it down because it's not something they want to do, or maybe they can't cope with it, or something comes up that they can't continue with the business. So I always suggest to keep it simple. Start your business as a sole proprietorship and run it, particularly if you're making income from employment. Start as a sole proprietor. Then once that business starts generating income, because sometimes business is tough. It's tough to get business up and running. And so you may run a business at a loss for the first year, for maybe the first 2, 5 years. Now, once the business starts generating income, that's when you can consider incorporating, because now you don't want the income to be added to your primary source of income, right? Except you don't have any other source of income. If you don't have any other source of income, then maybe you can run that business a little bit longer as a sole proprietorship. Then once the income starts growing and growing, then you can roll it into a corporation, right? And then start getting all the benefits of running, because a lot of the benefits of running a business as a sole proprietorship, you still have it even when you run it in a corporation, right? The biggest one is just the tax differences. But if you're going to be spending all the money that you're making in the business, then you can as well just run it as a sole proprietorship.
All right, Ken, last one from me. In terms of real estate investment, I've heard people talk about cash flow strategy and capital appreciation strategy. As somebody who has been in this space for a very long time, which one would you, ponder to us, or why? Or would you rather say we should maintain both or just do one, please?
Well, personally, I have a bias for income, right? So I like my investments to always generate income for me, because I think income is great. Income will help you um, sustain some of the things you want to do, will help you invest even more. So I am biased towards income, but I understand that sometimes it's in the markets we have today, it may be challenging to have a property or an investment real estate that will give you that income. So if you already have a source of income, then I'm going to be a little bit indifferent about investing in real estate for cash flow, right? The only thing I do is to make sure that at the end of the day, there is a positive return when I combine the cash on cash return with the mortgage, the return from the mortgage pay down. So when I combine those two and that number is positive, and I have the extra income to deal with, let's say the property is generating a negative cash flow. If I have the extra income to deal with that negative cash flow, then maybe I will do it. I will invest in it. Because I know over the long term, there's going to be appreciation, right? Over the long term, I can pull out equity to invest in something else. And so I just look at the cash on cash return, the return from the mortgage pay down. And once those two numbers, once the combination of those two numbers is, if it's positive, then I'm always ready to invest.
Thank you so much for, for the time you've given me to, to share with our community. The funny thing is, when I first heard Ken Green, just like you said, I didn't think Ken was a Nigerian. It took me a very long time before I knew he was a Nigerian. When I first saw him, I thought he was one of those East African, person. Until he told me he was Nigerian. Like, how come you have full English name, not any, sort of local name? So I want to tell you that, I respect the fact that you are contributing a lot to to the development of our community, especially in the area of investing, and then, building financial legacy and all of that. And that's one of the reasons why you and I, connected a lot, because that's something that I want to also do. That's a vision that I have. I want to take a moment to thank everybody who has stayed here, to talk to us today. We would have another session tomorrow evening. If you want to join us, I just quickly put this on the screen for anybody that wants to come to the session tomorrow. If you are interested, you can join us tomorrow evening for this, something that I call Financial Life in Canada. I'm going to put the link in the group for everybody that wants to register. You could just use that link to register in the group. Thank you so much, Ken, for your time. Thank you, everyone, for coming and then listening to you guys. I hope that this has benefited you in one way or the other. I recorded this, so I'm going to be putting the recording in on my YouTube channel. So whoever needs the link, I can share the link whenever it's ready. I'll share the link with you, Ken. You can also share with other people in the community, just so that people can learn about the things that we've spoken about today. I want to say thank you, and then wish you guys a good evening and enjoy the rest of the weekend. Thanks, everyone.
All right, thank you, everyone, and thank you, Bisi, for this. So I appreciate it. All right, so have a good night, everyone. Enjoy your evening and your week.